All right. So let me share my screen. First of all, thank you for the organizers. Thanks, Andrew, for setting this all up, and thank you, Joss, for joining the team. So it's a real pleasure for me to present this paper today. It's joint work with Corey Garriott and Marius, who was also here in the room. And the paper is called "Do High-Frequency Market Makers Share Risks?" So the short motivation, I mean, for this audience, I don't need to motivate too much, I think, the role of the limit order book here. But a key element there is that the limit order book ranks incoming limit orders by price time priority. And we know that the majority of exchanges worldwide use limit order books. And this role of price time priority is something that we want to investigate a bit further today. So we're going to take the traditional convention of looking at market makers who supply liquidity to the book, and then traders come in with market orders. But then the sequential nature of the limit order book implies that market makers absorb these incoming trades one by one. So the first market maker in the queue, his limit order will be executed entirely, and only then, if the incoming market order is large enough, it will go to market maker 2 or 3. So this means that at least at high frequencies, these market makers cannot perfectly share risks as compared to, for example, a double auction, because in a double auction, they would submit supply schedules, and then it's possible if an incoming order flow shock arrives, that each market maker takes a fraction of this shock. So whereas in double auctions, they can share risks perfectly, in a sequential nature of the price time priority limit order book, they can't. And this is also quite surprising, or quite important, I think, because you can also think of some sort of a dealer market. In a dealer market, if you're going to have, let's say, one dealer who has a long inventory position, a second dealer who has a short inventory position, then you can imagine that the long dealer is most eager to sell, so he would quote the most competitive ask price, whereas the short dealer would quote the most competitive bid price. So even in a dealer market, so these prices you're going to get very quickly, that the inventory positions are going to converge rather quickly. So that's the conventional wisdom we also see in the literature, which typically assumes that the market making sector absorbs the incoming trades and somehow shares risks. And now today we're going to show that this is not really going on, at least in the HFT world. So some of the questions that we're going to look at, let me try to, yeah. So some of the questions we're going to look at, the first one is, well, very simple. How well do market makers share risks? And this is we're going to see that it's not so much, not good at all, to be honest. And we're going to link this to time priority. And then we're going to ask how time priority and queue positions in particular are going to affect the limit order sizes that market makers submit. So that's going to be the theoretical model. And then empirically, we're going to be able to estimate the model as well. We're going to have a private data set with trader identifiers. It also includes the identifiers of limit orders at the BBO. So we're going to see at snapshots of the BBO, we're going to see the queue positions of each market maker or each trader that's submitting limit orders. We know their identifier, and we know the sequence with which they appear in the queue as well. So that's going to be important. So it's going to be nice because we're going to be able to estimate the model in that respect. So a quick overview of the talk. We're going to empirically document 3 stylized facts. And these stylized facts are going to motivate basically the theoretical analysis. And these stylized facts are based on a data set from 2021, January to August, from the TMX Montreal Exchange. They allow us to identify 12 market makers that are also high frequency traders, and we're going to study their behavior basically. We're going to have 3 assets: the 5-year futures contract of the Canadian bond market, the 10-year futures contract, and the equity futures index. That's the TSX 60 index containing the 60 largest stocks in Canada. Then we're going to offer a simple theoretical model to look at limit order sizes that are going to be submitted by these market makers as a function of their inventory position, as a function of their queue position. We're going to be able to solve that. And then we're going to be able to take that model to the data. And one advantage is going to be that we're going to be able to estimate the magnitudes of inventory frictions and adverse selection frictions, but in this case identified from the limit orders submitted by market makers. All right, so this is the overview of the talk. Let's see. So whenever here we are. So let me start with the stylized facts here first. I'm going to have 3 of them. So the first one, this is not novel at all, but it's important to show in this study. So we're going to have 12 market makers identified using the standard approach in the literature. And for each market maker on each day in the sample, we're going to calculate their inventory half-life. So we run an AR1 model, and across days and across contracts for each market makers, we're going to have these box plots that shows the distribution of the half-lives in our sample. And as you can see, the large majority of half-lives is about 5 to 10 minutes, but we should also see here in the box plots the minimum and maximum values, and there are some outliers every now and then, but the vast majority of these market makers, they unwind half of their inventory within about 10-15 minutes. So this shows that they truly care for inventory. And this is something I think that we already know from the literature as well. So I'm trying to keep an eye on the chat as well. Yeah, thanks, Andrew. So if you guys have questions, please either just open up the microphone. I'm going to be happy to take them on the fly, but I'll also try to keep an eye on the chat. And Marius is here as well to answer any complicated questions for that matter. So on top of their low half-lives, the market makers that we have in 72% of the days, they end the day exactly flat as well. So they really care for inventory positions, I think. So now the second stylized facts, we're going to focus on whether these guys actually share risks. So we're going to have 12 market makers. For each pair of market makers, we're going to get the correlation in their inventory positions. We're going to calculate all pairwise correlations and show them each day and show them in a distribution, basically. And we do this for 3 sampling frequencies. So we sample the inventory either at the 30-second windows, 30 minutes, or 2-hour frequency. We calculate the correlation day by day, and then we get a distribution. And from this distribution, we can see what's going on. And from the traditional literature, we expect them to share risks. That means that either in a given instant, all market makers will be long, or they're going to be all short. So we expect some sort of a positive correlation between them, that they co-move. But actually, this is something that we don't see here in this figure, because the average correlation is about 0.1. So it depends a little bit at the sampling frequency that we use, but the mean of the distributions are very close to 0.1. So 0.1 correlation is extremely low. It's close to being uncorrelated, I'd say. So we see a bit of tails as well, but this is really puzzling, I think. So there's a question by unit. The results are almost by assumption, because you define market makers as those with low inventories throughout the day. Yeah, that's true. Sure, we do this by assumption, and so this first stylized fact is in that respect not too novel, but we define market makers as being trading a lot and unwinding position. Yeah, I agree with that point. And as Marius said, there's going to be a huge gap between these 12 market makers that we have and everyone else in the market. So there's something really different between the ones that we study versus the ones that versus everybody else. Thank you, Unit. And another interesting data or observation really is that only 12.4% of volume is between HFTs in our data set, despite them participating around 75 or 80% of all the trades. So these HFTs don't seem to trade much among each other. And this is also very low if you look at a bit of an older literature. For example, the LSE dealers in the 90s, they had about 24% of trades were between them. And in the corporate bond market over a period from, I think, 2010 to 2017, about 30 to 40% of all trades were between these corporate dealers. But in the current market, we see that this is not the case. So this is really puzzling. You want to ask, does the correlation change at lower frequency? No, because in the majority of days, 70% of the days, they end the day flat. So it's really them unwinding inventories very quickly. And if they unwind inventories very quickly and end the day flat, then at lower frequencies, this correlation is also going to be very low. So now the stylized fact number 3, we're going to ask whether Q position is correlated with this inventory position. So you can think that a long market maker wants to be early in the queue on the ask side to be able to unwind his position. So we ask simply, can he manage to do so? So what we're going to do is for every snapshot of the data that we have a Q position, so market maker 1, 2, 3, 4, 5, etc. And for each market maker, we observe the inventory position at that point in time. So we can just calculate a correlation. And this correlation, we do it for all the snapshots in the data and for all the contracts that we have. And we're gonna have a bit of a complicated picture here, but it's gonna be two distributions, one for the ask and one for the bid. And the answer is gonna be no, they can't really. So for example, let's take a look at the ask side in blue. So this is the blue distribution that we have here. The mean of this distribution is minus 0.1. So on average, you can expect that, for example, if a market maker is long, he wants to be early in the queue on the ask side to be able to sell. So ideally, there would be some sort of a negative correlation here, meaning that the longest market makers in each point in time are early in the queue to be able to sell. But this average correlation is just 0.1, minus 0.1. So it's non-zero, but it's very small. So practically, the ones that are most eager to sell are not going to be able to get this queue advantage, are going to be able to get earlier in the queue. Once we make the same picture for the bid side, the average correlation is 0.1 but positive. And here again, it's close to zero but positive. So this would be the positive correlation. Kind of makes sense because it means that the shortest market maker, the ones with the most negative inventory positions, they want to be early in the queue to be able to buy, and they are barely able to get some sort of a queue advantage here. So we're going to interpret this as this low correlation of minus 0.1 or plus 0.1 as being almost no correlation at all between their inventory positions and their queue positions. And this is kind of troubling if you think of some sort of a welfare perspective, because from a welfare point of view, you would like the market makers most eager to trade to be able to appear first in the queue. But in practice, all that's going to happen is that whenever you want to trade, you're just going to have to get in line basically and submit your order at the end of the queue. So these three results, they draw a striking picture. We see that the market makers care deeply about their inventory position, so half-life less than 15 minutes on average, yet they have very low inventory correlations between them at various sampling frequencies, which suggests poor risk sharing. And in the queue of limit orders, the ones that are most eager to trade, they somehow seem unable to get this advantage in the queue. So this again seems to be an important friction. So some of the questions that we're going to go for is, again, how do queue position and inventory affect limit order sizes, and what is arrival sequence with which the market makers appear in a queue, whether this is going to matter, and ultimately we want to say something about this risk sharing and efficiency.
Vincent, can I ask a quick question?
Please.
Is this an alternative explanation, maybe that they're all hunting for short-lived information, and once if you know the information is coming, you take a position on the right side, then the information gets revealed, then you get out, and then you don't. So you will show these patterns actually that eventually mean reverts, but they're not really market makers. They're just chasing information and want to benefit from it. And I guess the way to distinguish this from the other is, you want to have some statistics on whether they trade through limit orders or through the market orders.
Yeah, that's right. That's a very good point. We're going to see that, I think, from the top of my head, about 80% of their trades are through limit orders. But what's more, the ones that we call market makers, we require them to actively submit quotes to the book. So we're sure that these guys, they quote a ton of limit orders. They quote nearly continuously in the book, at least on one side. So they do market making for sure, but it's possible that on top of that, they do some sort of maybe statistical arbitrage or some sort of news trading on top of it. That we cannot distinguish, but we're very sure that they're going to trade a lot through limit orders, and that these guys are continuously quoting basically.
Yeah, and you could look at whether their position taking is on transitory price changes or on permanent price changes, much in the spirit of what we did in our paper.
We considered that, but so in this paper, we're going to go for trying to identify the inventory friction through the sizes of limit orders instead of through price pressures, which is the traditional approach, let's say. So then we try to stick with this kind of clearer point, if you will, or our contribution here in terms of then identifying inventory frictions. Yeah, thank you.
If you drop cases where it's not tick constrained, how much does that correlation between your inventory and being at the front of the queue change?
So this is a very good question. So in this case, our assets, these are futures that have relatively wide tick sizes, and this tick size is going to be binding the majority of the time. I'm going to be almost here. So this means that on the one hand, they're going to be very long queues in the order book. So this makes our friction more important for this for these assets, but we're not going to be able to say much about comparing periods where the tick size is binding for the spread or not, because in the end, there's quite little variation, I'd say. And once there is some variation, it's also a bit endogenous, I would say, because it's going to be right around the illiquid time periods. Yeah, so this is the downside. We only have 3 assets here, so we don't have cross-sectional variation in relative tick size. So our contribution, we're going to offer a simple limit order book model, but we try to introduce as many of the elements that we're going to need for our story. So these we're going to have 4 elements that are all going to be necessary. We're going to have adverse selection, market maker risk aversion. We're going to have discrete prices with time priority, so this queuing element basically. And then we're going to look at imperfect competition between market makers as well, because in the older literature that we're going to cite, it's going to be mostly competitive markets. Yeah, so Marius says, adds to the previous points that the theory works best for tick constraint stocks, because that's the way how we're going to solve the model as well. So undercutting is not going to be relevant here. So the first observation, I just mentioned this, it's time priority together with sequential execution is going to generate heterogeneity in market maker inventories. So this is going to motivate studying heterogeneity in market maker inventories on the limit order strategies. And we're going to have both adverse selection in the framework and risk aversion of market makers, so both classical frictions, and these are going to interact in some way with each other in the following manner. So suppose the first market maker in the queue, he has a very large inventory position that he wants to unwind. So he's going to offer a very big limit order to, on one hand, being first in the queue and trade to have a profitable market making gain, but then he's also going to offer a large limit order to unwind his position. Now, this limit order is going to be larger, so every market maker that arrives after him is going to be later in the queue, and they're going to be later in the queue, so they're going to have higher adverse selection as well. So in the model, we're just going to have linear price impact, and that's sufficient to get this result. This goes back to Gloster 94, basically, that says that the deeper that you are in the queue of limit orders, your limit order would only execute against larger and larger market orders, and larger market orders tend to be more informed on average. So you can either think of one large market order that's more informed than a small market order, or you can say, well, perhaps the limit order deep in the queue is only going to execute after many small market orders come in, and multiple small market orders are going to have higher price impact than a single small order. So if you're first in the queue, you execute either against a large or a small market order, but then also including these small market orders, you can have this lower adverse selection risk there. And this means that if this first market maker in the queue offers this large limit order to unwind his inventory position, then all market makers later in the queue are going to face higher adverse selection effectively, so they're going to reduce the limit order. So this is some sort of a crowding out effect. And this also shows immediately that the queuing order matters, in the sense that if the first market maker is very long, his large limit order will crowd out liquidity provision by everyone else. Whereas if he would appear at the end of the queue, being last in the queue, there would be no crowding out effect at all, because there's going to be no impact on the market makers that arrived earlier in the queue. So this shows that queuing order matters through this kind of crowding out channel. And this crowding out channel immediately implies that there's some sort of a trade-off or a tension between the depth in the market, the quoted depth, and the optimal risk sharing from a market maker's point of view. So market maker risk sharing would say that the market maker most eager to trade should appear first in the queue, but then we get more of this crowding out effect such that the total depth is going to diminish. And the converse, from a trader's point of view, they would like to have more liquidity in the market. They want to have the market makers with the largest positions, or the ones that are most eager to trade, to arrive last in the queue, basically. So this tension is kind of novel, and I think it's interesting as well. So let me. Here we are. So somehow, whenever I click in the slide, then my buttons don't work to show the next slide. But that's okay. So after this theoretical contribution, we're going to take them all to the data, basically, and we identify a simple linear regression that exactly maps to the equations of the model, and then we can estimate essentially the model. So we're going to have on the one hand the standard interpretation of a linear regression of limit order sizes on a bunch of variables, but now we're also going to have this structural interpretation within the model. And afterwards, we're going to quantify this risk-sharing inefficiency just through some sort of a back-of-the-envelope calculation. And we're going to show that this arrival sequence of market makers affects a lot the quoted depth in the market, basically. All right, so this is a good point. So before I'm going to start with the model, oh, sorry, I've got the related literature still. Yeah, let me discuss very briefly the related literature, maybe afterwards take a few questions and then dive into the model in case there are any. All right, so what do we contribute to? So there's an older literature that looks at risk sharing between market makers. I think it's important to do this type of analysis again, but now in a high frequency world, because we know that these inventory frictions are going to be much more important nowadays. We also relate to limit order book models that are used to estimate at first selection. So we're going to use a similar style of limit order book model, but now also estimate inventory frictions. We can do that because we have these trader identifiers in the data. And then there's a large literature that uses price pressures to calculate or estimate inventory frictions. Now we're going to try to answer similar questions, but using the sizes of limit orders. And then lastly, we also contribute to the role of the tick size on limit liquidity provision, because the tick size effectively is going to determine how long the queues are in the limit order book and how important this friction is that we study. All right. So I think there are a few questions in the chat. Let me just, one from John and one from Dominic. Let me just try to read these and then answer them. So John says, do you have a guess on the probability of filling a resting order? Curious if there is a high chance of canceling based on your position in the line. So we haven't calculated these statistics like fill rates, for example. So I always think that they're a bit limited, because usually when traders have lots of dynamic strategies of canceling and resubmitting limit orders, then the fill rate of one individual limit order, I never find it so important. But on the other hand, perhaps this is now more important if there are long queues like we have in the current data. I'm not sure if there's a high chance of canceling based on your position in line. I do think that your queue position is quite valuable because it's going to affect strongly how long it takes for the limit order to execute. So that's for sure. And Dominic asks, do you look at correlations with lead lag? Risk sharing could happen over time. Price pressure could push prices away from fundamentals, attracting other market makers. Yeah, but the lead lag relationship, in the end, if this really works, then it just takes a while, but then inventories eventually will converge, right? So they will, all market makers will either be long or all of them will either be short. And they should pop up in our analysis, but actually it doesn't. So we see that the correlations are just about 0.1 on average, which is really low. Can you say anything about parity trading at New York Stock Exchange, trading outside time price priority? So now we're really restricted to these assets that we have with large tick sizes. So I don't think we can say anything really. I mean, I can make a guess, if anything, but I'm not too familiar with parity trading, to be honest. So I would have to think about that a bit more, probably. All right. So thank you for these questions. Let me go to the model then. Yeah, so it's going to be a very, I'm going to say simple model, but I actually think that this time it's a simple model. The solutions are not going to be too complicated, and I'm going to have some nice pictures, so don't worry. So we're going to have a single asset that just pays off V tilde in period 2, and the ex ante, the initial expectation of it is just V. We're going to study a one-tick market, so a single ask price and a single bid price at which market makers can submit limit orders to. So there's going to be no undercutting, there's going to be no liquidity deeper in the order book. This is going to greatly reduce the state space and in terms of the number of actions that the market makers can make, but more often, or more importantly, it's going to simplify the expectations that they need to form. So usually if a market maker early arrives, he needs to form expectations of what market makers later on are going to do. And in our cases, we completely shut down this channel, so we don't need that. They're going to be market makers who start with an initial random inventory position. It can be anything. And their final payoff is going to be their wealth evaluated at the fundamental value in period 2, and then minus a quadratic inventory, or is quadratic inventory multiplied by an inventory penalty. So gamma here is going to be the inventory penalty, and the way we think about this is that this gamma is kind of incurred constantly, this small penalty basically over the squared holding. So whether they are either long or short relative to their target, that's what's going to matter here. And then we're going to have impatient traders. The trade sizes are going to be drawn from an exponential distribution. And we're going to assume, following Sanders 2001, that there's just going to be a linear price impact. All right. So if the draw from the distribution turns out to be a large one, then the order is more informed according to this linear rule here. And that imposes more adverse selection on the market makers. So this is all very simple and very standard, I would say. So the timing is as follows. So first market maker 1 arrives, submits a limit order, the bid side at the ask side, then market maker 2, 3, and so forth. Then at T1, the impatient submits this trade, market order, market clears, and payoffs are realized. So very, very simple here, just a one-shot game. And the equilibrium condition here is that each market maker submits a limit order with a certain size such that its marginal limit order, so this individual unit at the end, this last marginal limit order, that one earns 0 expected profit, incorporating the inventory position that he has and the adverse selection based on his Q position. And this condition is the same as, I'd say, Gloucester 94, but Gloucester 94 would consider a competitive market maker or market making sector. So then this condition only holds at the end of the queue. But in our case, we're going to have multiple market makers. So this condition is going to hold for each market maker individually. And this condition also is going to identify the optimal limit order of each market maker. And here the equations look a bit long, but this is basically the whole model. This is the solution, if you will. So what does the optimal limit order Q on the ask side of market maker J, so number J in the queue, what does it consist of? Well, first we have some sort of what we call a risk adjusted pi. So that's the difference of the best ask price minus the initial expectation of the fundamental value minus some sort of an adverse selection term. And we divide it by gamma. So this is the risk aversion parameter. So this is really some sort of a risk adjusted pi. Will the first market maker in the queue take the whole pie? Well, he would like to, but he can't. Because if he's going to offer a very large limit order, then he's going to take more of the pie, but at the same time, because of his risk aversion, he's going to shift his limit order a little bit. So he's going to take a fraction of the pie, and this fraction is proportional to the term that we have here. So there's gamma risk aversion divided by gamma plus lambda. And gamma plus lambda, that's basically the inventory penalty plus the information, the informed trading parameter. But gamma plus lambda really is the marginal cost of liquidity provision. So we take gamma, so the inventory component of the marginal cost of liquidity provision, elevated to the power j. So if you're the first market maker, you're going to get a big share of the pie, the second one slightly smaller, the third one even smaller, and so forth. Then we're going to have a direct effect of the inventory position of market maker J on its limit order. And here again, we multiply this by the fraction of the marginal inventory cost due to inventory, if you will. And then this large term in red here is the crowding out effect. So suppose your market maker J is 3. How big is your limit order going to be? Well, it depends on the limit order submitted by market maker 1 and 2. And the limit orders by market maker 1 and 2 depend on the inventory position. So we get this kind of a convoluted term here that depends on the inventory position of market maker 1 and 2. And intuitively, if these are going to be larger, their limit orders are going to be larger, then the limit order of market maker number 3 is going to be a bit smaller according to these proportions here. So I don't want to focus too much on the exact equations here. Let's instead just continue, continue through a numerical example. So I'm going to have one picture here that basically summarizes the model, I think. So we're going to have a numerical example, 3 market makers, and all 3 market makers together own 6 shares of the asset, or 6 contracts, if you will. And we're going to compare cases where these 6 contracts are basically dispersed in a different fashion. So in the first column, we're going to have market maker 1 is going to own all 6 contracts. Market maker 2 and 3 are going to have 0. And here we have 222 or 006 and so forth. So in the first column, what is the equilibrium liquidity offered by the 3 market makers, their quote size? Well, market maker 1, he has 6 shares, and we're looking at the ask, so he's going to sell. So he wants to sell on the one hand a large amount to unwind his inventory position. He has 6 shares, but actually he's going to quote for 7. He's going to add the 7th share as well, because this is still profitable from an adverse selection point of view. So the first one submits a really large limit order for 7 contracts. And then market maker 2 and 3, they're going to offer a positive quantity still, but a very small quantity. Why positive? Well, once they arrive to exchange, their initial inventory position is still 0. So they can absorb a little bit of inventory for them to take it, but otherwise not much more, because that first selection risk is already really high. In the second column, we see the case, the same setting, but now each market maker starts with an inventory position of 2 contracts. So it's perfectly risk sharing among them. The first market maker is going to offer 5 shares. So on the one hand, much more to unwind his two share position, because he's first in the queue and faces low adverse selection. So he's going to offer still a fairly large limit order. And then market maker 2 and 3, they offer still quite sizable limit orders as well, simply because of risk sharing on the one hand and adverse selection on the other hand. And let me finish by looking at the third column here. The fourth one we can ignore for now. So this is the case where the first and second market maker have 0 inventory position, and it's only the last one that has all 6 contracts. Now we're going to get this result. So the first market maker is going to offer about 4 contracts. He's first in queue, low adverse selection, offers 4 contracts, but not more than 4 contracts, because after executing these 4 contracts, he's going to have a quite large inventory position, which is going to hurt him. The second market maker also offers a significant quantity, and then the third market maker offers quite a large quantity. On the one hand, he would like to offer a limit order of 6 shares to unwind his inventory position, but actually he's going to offer a little bit less than 6 shares, because the adverse selection risk of being so late in the queue is so high that he prefers to sell a smaller or submit a smaller quantity because the adverse selection risk is just too painful. So this also shows that the left column here, the first column, is basically the ideal setting for the market makers, in the sense that the market maker most eager to trade is first in the queue. So this is kind of optimal from a risk sharing point of view. But then the total depth is quite low because of this strong crowding out effect. Whereas in the third column, let's say, this is worse for the market maker, because the market maker most eager to trade is at the end of the queue. But the quoted depth is going to be larger, because this large limit order at the end of the queue does not crowd out the liquidity provision by market makers 1 and 2. So this is basically the model. So empirically, we're going to take the previous equation that we saw on the previous slide. So the equation for the optimal limit order size, we can take it to the data. And we're going to ask, do the individual limit orders depend on inventory position and queue position? And we're going to find that this is the case. Then can we identify these inventory frictions and separate it from information frictions? We can, and then we're going to look at the risk sharing inefficiency and the role of this queuing arrival sequence on quoted depth. And then we pretty much call it a day, let's say. So just to end the model with a bit of discussion, what are the strong assumptions that we make, the ones that are really painful, let's say? Well, it's a static model with only a single bid and a single ask price level, so no undercutting going on, no liquidity deeper in the order book that you need to incorporate, so it's a very strong one. And we're going to have exogenous market order flow, which is very strong. But what do these assumptions buy us? Well, we get quite a lot in return, I think, because we're going to retain this importance of this queuing dynamics. We're going to have imperfect competition between market makers, which is nice. We're going to show this crowding out effect, or this interaction between inventory frictions and adverse selection. And we have a simple closed form solution that we take to the data. So I think this is a kind of a nice trade-off, if you will. All right, so much for the model. Let me pause for 1 second, take a zip, and then ask, let's see if there are any questions in the audience. All right, very good. So let me just go to the empirical analysis then. Josh has Josh.
Yeah. Actually, Vincent, I'll take you up on your offer for questions. So in your introduction, one of the things you were saying is that there's kind of this like low correlation among market makers in terms of their inventory positions. And I was just kind of wondering, if the model can rationalize that in some way. Looking through the example you showed us, it looks like kind of there are some forces that push, uncorrelated positions towards more correlation. Is there a way to put a number on that somehow? It's not a very well-formed question, but I wonder if you think.
No, I think it's a very good question. So in the model works with any initial distribution of their inventory. So it's quite flexible in that sense, but it doesn't explain per se variation in inventory positions. But we do make this point that, of course, in any given instant, the first market maker in the queue, he's going to absorb the entire trade. And only if the incoming trade is even larger than market maker 2 is going to absorb part of it. So at least at very high frequencies, these market maker inventories are going to diverge at least a little bit because of this. So we don't formalize it exactly. What we could do is, let's say, take the model, repeat it, let's say, play the game 1,000 times, and let's see where the inventory positions are going to end up, or how dispersed they're going to end up to be. But we haven't done that. So for now, we just take it as a given, really. All right, thank you. So Pete?
Yeah, how do your market makers liquidate their inventories?
They just keep their inventory positions through time, and they unwind it by adjusting the limit order sizes. So if they're very long, they're going to offer larger limit orders on the ask side, and gradually they expect to sell it through that way. But there's no dynamic optimization going on. So it's just a static one that they look, okay, there's one trading game. After this trading game, payoffs are going to realize if I start with a long position, I'm going to offer a larger limit order on the ask side to try to unwind it.
So are you going to check in the data whether that's the case? Because my impression was a lot of times market makers liquidate their inventories by hitting bids or lifting offers.
So in the model, we're going to assume we follow this classical separation of market makers only using limit orders versus traders using market orders. But in reality, it's a bit of a mix. So that's something we're not going to be able to say much about, for sure. One of the, perhaps a third strong assumption of the model, for sure. So Peter asks in the chat, empirical data demonstrate market makers trade mostly with retailers rather than among themselves. Yet in the simulation, they trade among themselves. Am I missing something? So in the numerical example I gave, they don't trade among themselves. They just quote basically, and then they trade with the incoming market orders. So we take the extreme case that they, in the model, we take the extreme case that they never trade with themselves. But in reality, we saw that I think about 12% or 10 or 12% of trades in our data are between HFT market makers. So, okay, how do we identify, excuse me, so let's first talk about the data. We're going to have 30-second snapshots of the BBO with these queue positions of the market makers, 3 assets. All the transactions and all the limit orders contain the same anonymized ID. We include lit orders and iceberg orders. And we also have the queue position at each snapshot at the BBO. And we have January 1 to August 18, 2021. And this market has strict price time priority rule. There's no price time broker rule or something like that. Corey makes a good point. On the Montreal Exchange and these assets in particular, there is no retail order flow basically. Because we're talking about very large, for example, the 5-year bond contract has a nominal value of about $100,000 Canadian. So I think there are not too many retailers that be able to trade these amounts. So what do? So first identify the 12 market maker accounts. We follow Kirilenko, Kyle, Samadi, and Tuzun. They need to trade a lot. They cannot be allowed to build significant positions. So at the end of the day, they need to have less than 5% of the net position. That needs to be less than 5% of the volume they make. We're going to see empirically that this one is not binding at all. So the market makers that we find are going to have much lower end of day positions. And they also need to mean revert often during the day. So this is all the standard conditions in the literature. And then we add a fourth one of our own. We need that they have a quote at the BBO in at least 20% of the snapshots. So without this fourth condition, we would have 22 candidates of being HFT market maker. But actually with this condition, we drop 10, which seems to be a lot. But the ones that we drop hardly use limit orders at all. So we're left over with 12 market makers, and these 12 market makers offer 97% of the limit orders that all 22 of the market makers or the candidates did. So just by adding this criteria, we're just going to be sure that we really have these quoting market makers in there, as opposed to some other HFTs, basically. Jonit asks, why not only define market makers as two-sided limit order submitters? Yeah, that's a good one. So we're gonna have a picture. I'm not sure if it's in the paper, in the presentation, but there's a picture, and we're gonna that shows the fraction of the time that they offer one-sided liquidity and two-sided liquidity in the market at the BBO. And many of them, at a given instant, they offer mostly one-sided liquidity on one side of the market. So suppose that they're long, then they want to sell, so offer only liquidity on the ask side. And conversely, once they have a short position, only on the bid side, but they still would be labeled as a market maker in that respect. Why do we need to impose conditions on volume? Yeah, that's a good condition. That's a good argument. We follow the literature here, really. We don't want to innovate in identifying or in the definition of what's a market maker. We try to avoid this, let's say, a can of worms discussion, and try to follow just what the literature does. But in practice, it's not gonna matter too much, because the ones that we do have, they follow all the intuition, basically, that we have what HFT market makers do. So here's some summary statistics. We have it on the market maker accounts and then everybody else in the data. Well, the market makers, they trade a lot. Then average net position is 0.4%. So this relates to the criteria that we had on the previous slide. And the standard deviation of inventory is also very low. What's the time at the BBO? 53% on average. So this can be either one-sided or two-sided. Non-market maker accounts, they are hardly ever at the BBO, so less than 2%. And also the net position end of day, as a fraction of how much they traded, is going to be 73%. So non-market makers are really much more one-sided, either buying during the whole day or selling during the whole day. All right. So first we're going to look at question number 1. Do individual limit order sizes depend on inventory and on queue position? So very basic. We're just going to make some pictures here. We put the snapshots that we have. We're going to put or create quintiles for each market maker. And at a given snapshot, they're either in quintile 1, 2, 3, or 5. So either short or long. And we're just going to look at the quantities that they offer. And here we're going to do a trick. We're going to look at the quantity which is the ask quantity minus the bid quantity. By separating these two, because the impact of inventory would be the opposite on the ask side versus on the bid side depth. So by taking the difference, we see it more clearly. And we see a near monotonous relationship here. So on average, an individual limit order in our data set is 1.8 contracts. And for example, if your inventory is in the low quintile, you offer minus 0.4 reduction. And if you're in the large quintile, you offer plus 0.4 size. So that's basically a 0.8 difference, and 0.8 is about half of the average limit order size. So inventory, if you just compare these quantiles, there seems to be a large impact. So this is just a simple picture. We can also do a regression of these limit order sizes. We control for the queue ahead, so the number of shares ahead of you in the queue, the total length in the queue, some other variables as well. We take the residuals and put these residuals into quantiles again, and then we get a very similar result with very similar magnitudes here. So there's some discussion going on in the chat. So Corey says it's an interesting idea. Jonit, question for you and the audience: would you prefer an empirical identification, or would you prefer MX to identify a list of known market makers or HFT, or both? Yeah. Jonit says, I would prefer all known market makers, not necessarily a high frequency trader, or if empirically identified, I would prefer to define them simply as two-sided. Although liquidity provision is surely more complex than that. Referee 2 would want both. So give us the list, Corey. Yeah. All right. Now we're going to make silly jokes. So let me continue with the presentation instead.
Vincent, just to add to that, we usually try to finish at around 45-minute mark. So since you seem to have 8 more slides to go, I'm not rushing you. I'm just saying maybe we'll focus on finishing and then we'll do the discussion at the end.
All right, very good. Yeah, let me try to hurry up a little bit. But I think we're going to be fine. So does queue position matter for quote sizes? Yeah, it does. Basically, if you're very early in the queue, so in the setting without any controls, there's not so much going on. What's going on, or there's no clear pattern here. What's going on is that if you compare different snapshots, the market conditions can be very different. and then we don't see this clear relationship between queue position and the size of a limit order. But once we add for controls, then we see quite clearly that this is a kind of a monotone reducing effect. So this is going to estimate basically or represent the adverse selection channel in the data. The later that you appear in a queue, the smaller that your limit order is. So this holds for these two pictures, but then we're going to do the same in a regression framework where we identify the magnitudes of inventory and information frictions. And so basically in the model, we saw this expression that says what is the optimal limit order size. That expression we just can take to the data. We're going to create a bunch of variables that exactly match with the variables in the model, such that we can map the coefficients that we empirically get to the structural interpretation of them. And then we can identify basically two terms. So this is the first one here is the fraction of price impact or informed trading divided by the marginal cost of liquidity provision. And we're going to have this gamma terms, which is the fraction of the inventory friction as a fraction of the marginal cost of liquidity provision. And here we're also going to use this result that we saw earlier, that there's a near zero correlation between queue position and inventory. This means that we're going to have a slightly cleaner identification, if you will. So let me say a little bit more about that in a minute. So the coefficient on queue ahead times dummy for the side, for the bid side versus ask side, this is going to identify adverse selection. So we standardize this variable. So a standard deviation increase in the number of shares that are ahead of you in the queue is going to reduce your limit order by 0.14 contracts. Remember that the average limit order was about 1.8 contracts. So it's economically, it's not large, but it's still economically relevant, I'd say. And the second one is inventory. So if you have a standard deviation increase in your inventory, then your limit order is going to increase by 0.15 on the ask side, and it's going to reduce that amount on the bid side. So it appears that because these two variables are both standardized, both of them are around equally large in terms of magnitudes. So we conclude that in this market, adverse selection and inventory is about of the same magnitude. Now, column 1 corresponds exactly with the model, the one-to-one mapping, if you will. We also consider a couple of variations in column 2, 3, and 4, and 5, and here nothing else changes too much. But again, I want to highlight that this near zero correlation between queue position and inventory implies that these two variables, inventory here and queue ahead here, are not going to suffer from a multicollinearity problem or correlation problem. So this is going to identify a little bit cleaner the coefficients that we have here. So can we quantify this risk sharing inefficiency? We're going to do the following back of the envelope calculation. And we're going to divide the actual squared holdings of each market maker over time by the sum of the squared holdings under perfect risk sharing. So if they would perfectly share risks, how big would their incurred inventory penalty be if we sum it over all points in time? And I'm going to get two results. So we're going to, the first one, we're going to do a simple summing, or we're going to say that each market maker is equally large. And when they're equally large, we see that this very low level of risk sharing that we see empirically could reduce this inventory penalty that they're going to suffer by about a factor of 8 or 10 approximately. Now, this comparison is not entirely fair because we know that some market makers are bigger than others. They have much larger inventory swings, for example. We can adjust for this, and then we're going to see that it's the number in the right columns here, about a factor of 4 approximately. So if they would be better at risk sharing, their inventory penalty would be 4 times lower, the realized inventory penalty. The nice thing about this calculation is that we don't need to know the magnitude of the inventory penalty itself, because we compare the actual squared holdings to the theoretical squared holdings under perfect risk sharing. So this means that under perfect risk sharing, this inventory cost would be significantly lower, I'd say. So does quoted depth depend on queuing arrival? Let me skip a little bit here and just going to say that it does. So we're going to have lots of snapshots in the data. At some snapshots, we see that the market makers most eager to trade appear first in the queue, and other snapshots we see that the ones most eager to trade appear last in the queue. We can compare that a little bit, those two cases, if you will, and we're going to see that the quoted depth is going to be affected, but by a rather small amount only. So let me We do the same with regressions, but let me skip that and then just conclude here conclude the paper. So what do we show? There's a crowding out effect. In this paper, we show that a large limit order to unwind inventory first in the queue is going to increase at first selections of everybody else. Later in the queue, it's going to crowd out the liquidity provision. So this immediately implies that the queuing sequence is going to generate some sort of a trade-off between risk sharing and liquidity provision. So from a risk sharing perspective, you want to have the market makers most eager to trade appear first, but this is going to reduce liquidity quoted depth because of this crowding out effect. If you want to maximize depth, you would do exactly the opposite, but then it would not be good for market maker risk sharing. And I think this market maker risk sharing, we can interpret this really as a welfare loss, because in the model, these market makers incur this continuous penalty over their squared inventory holdings. If they could do better risk sharing, they would not incur this. So this is a welfare effect. And of course, there are other groups in the model. So there are the traders, but the traders only care about quoted depth in the market. And the impact of the heterogeneity of market maker inventory on quoted depth is quite ambiguous, and in fact only depends on the queuing sequence with which these market makers arrive. So we can hold that part fixed, if you will. And then empirically, we show if the queue position increases by a standard deviation, quote size is reduced by 0.14 contracts. If standard deviation, if inventory increases by standard deviation, quote size is decreased by 0.15 contracts. So again, very similar similar impact, magnitude. And the arrival sequence randomness, to the extent that these market makers appear random in the queue, generates about 8% variation in market depth, only because of this crowding out effect. And then lastly, inventory positions diverge significantly, and the cost to market makers could be 4 times lower if they would better share these risks. So yeah, this is the presentation. Thanks for attending, and let's use the last couple of minutes for questions.
Yeah, folks. So Vincent, thank you so much. And if there are any questions, we can first of all transfer the chat discussion into a live discussion. And then if there are any additional questions, please just go ahead and mute yourselves and ask them.
So a really quick one. Do you have data on the other levels of the book?
No, we don't. Just the BBO.
Can I ask a question? So I see your paper and I like it quite a bit. I'm trying to figure out what we learn at the end, because somehow we believe there should be some kind of risk sharing. Someone does absorb those orders. Who are they? Are there market makers who are not high frequency market makers? What are we to learn? I think the conclusions go in a different direction than what I'm asking, but maybe I'm pushing you.
So I guess in the end, it's all between these traders. The market makers, they adjust their quantities in response to their inventory positions. But in a more elaborate model where they would also change prices over time, let's say. And let me think about this, because technically the incoming order flow is exogenous. So if you would repeat the game many times, then it's the inventory positions of the market makers are never going to converge to anything. I mean, they would converge to something a little bit similar between market maker, but they're going to be either, if you play the model, let's say 1,000 times, all of them are going to be very long or very short, presumably.
But I think Albert would ask you, I think he classified into high frequency market makers and high frequency bandits kind of. Can you convince us that these are not bandits? They just want to have zero inventory because they trade on this, on that, and they want to have clean profits at the end of the day, but they are truly market makers? What makes us think that that's what they are?
I think they're truly market makers in the sense that they quote a lot. If they would be really a bandit, I'm not sure if they would put limit orders in the book as often as they do.
Why not? If you're more efficient by using limit orders to be a bandit, why not do it? It's not clear.
So it depends on the source of being a bandit. So if it would be, let's say, news trading, news comes out and you quickly have to snipe stale quotes in the book, then your limit orders are not gonna help there. So for a news trader, I would say we kind of can reject that one. But otherwise, I think these guys in practice, they do a bit of both. I mean, you have your market making algorithm running, and suddenly you see some sort of a sniping opportunity, then you're also going to take it, right? So it's not super clear. So Dominique asks in the chat, shouldn't sizes be secondary and prices at first? Inventory should affect price, isn't it? Yeah, that's true, Dominic. So in this case, the model talks about a binding tick size, if you will. So the bid-ask spread is one tick only. This is by construction in the model, but it happens a lot in reality as well. So in that case, we can look at the quantity dimension. So Peter says the last OLS plot was scanned too quickly to understand its significance. Yeah, apologies for that. So that was to rush it over to finish in time, but basically it was everything that was in the picture there. So the picture before it showed that in snapshots where the market makers most eager to trade appear first in the queue, quoted depths are going to be a little bit lower. When they appear last in the queue, quoted depths are going to be a little bit higher. And this is all due to this crowding out effect that we have. So that just consistent with the model there.
Oh, I couldn't even read the axis, what was on the axis. I'm sorry.
Yes, my apologies.
Can you show the slide,
I guess
please?
I skipped the pictures, but I'm happy to explain it in more details, perhaps afterwards if you're interested. Thank you. Dominic asks, isn't the real risk holding inventory overnight? Maybe compute correlation of inventories at the end of the day. Yeah, so 70% of the days they're already flat, and the remaining 30% of the days they're gonna unwind mostly the next day. On special days, macroeconomic announcement, witching days or something. Yeah, we could take a look at that, but the model doesn't speak to it directly, I think. So for now, for our identification, for example, of the fraction of the friction of limit adverse selection versus inventory, I don't think we would really need it. All right, so it's 1 o'clock, I'd say. If there are no further questions, I'd be happy to talk more to Peter to explain the last graph.
Yeah, Vincent, we're not really restricted on the end. It's just that we try to get the presentation down to an hour so that people who have to leave can. But we have pretty much unlimited time now. So if you'd like to show that graph, that'd be great.
Oh, sure. Yeah. All right. Thank you. So this is the first the picture, and then next the table was the same results but with regressions. So what we do here, each snapshot we calculate the correlation between the inventory position and the queue position. So we're going to have a queue with market maker 1, 2, 3, 4, 5, let's say, and each market maker has its inventory position. So we're going to get a correlation there. In some snapshots, this correlation turns out to be positive, sometimes negative. So to the extent that the market makers arrive, let's say, randomly to the market, you get some sort of random variation there. And then we see that on these snapshots where this correlation is negative, so that would be the market makers most eager to trade, as when the long position, they indeed end up being early in the queue, which is what they want. Then the quoted depth is going to be a little bit lower, 37 contracts. In snapshots where it's the other way around, it's about 39 or 39.5 contracts. So it's a small difference, but this is all due to this crowding out effect, if you will. This is the picture without controls. The picture with controls is pretty much the same in terms of magnitudes. And then we did it with some regressions where we calculate this correlation coefficient that I just mentioned. And then we see that if this correlation is higher, then the quoted depth is going to be also higher. For example, it's about 1 contract if the correlation goes from, let's say, 0 to 1 or from -1 to 0, about 1 contract more. So this magnitude compares with the previous picture that we saw. That's all. Nothing too controversial, I think, of this last result in the paper.
Vincent, I'm really slow. Can you go back to the graph which Peter mentioned? So,
right.
So this is a version of your picture which shows like whether it's like the one with the largest inventory arrived first, right? Okay. Is that something you try to show? Basically, in the previous one, the 600, you show one example. This is a visualized in the data, right? Am I right?
Exactly. This is the same picture, if you will. Yeah, very similar.
Okay, so basically the main message is like, suppose your inventory is high, right? you arrive later, the total depths will be higher.
Exactly.
Right?
Yeah.
Okay. Okay.
Yeah, it takes a minute to wrap your head around it. So personally, I find the picture in the model much clearer. Then you see the decomposition, the decomposition where it actually comes from. But it's exactly right as you said. So if the first market maker has all the inventory, is most eager to trade, arrives in the queue, is going to be very happy. But he offers a very large limit order. This crowds out liquidity provision by market maker number 2 and 3. They're going to offer less of it. And because they offer less liquidity provision, the quoted depths are going to be smaller. Now, what happens if the same market maker with all the inventory position appears last in the queue? Then there's no crowding out effect because he's last in the queue. There's no one else coming after him. So there's no crowding out effect by definition. And then we see that the quoted depth is a little bit higher. And the last picture in the table is just empirically quantifying this.
Okay. I see. And also in your picture, actually, some of the picture you show when you without a control for symbol, you basically you also have cross-sectional variation, right? Am I right? So basically, lots of
is it this one? Excuse me. Which one? This one.
Many actually. You present two pictures. Sometimes you control with no controls. Putting another way, with no controls, you actually pull everything together, right?
Exactly.
Even different symbols. So
exactly.
I guess probably lots of things will be like cross-sectional differences across symbols.
That's true.
Right?
So for example, let me go to this regression if you allow me. So what we do here, the variable Q ahead and inventory. I didn't mention this because it's a bit of too much detail for the presentation, I thought. But these variables we standardize at the contract level. So if you have one contract, for example, the government bond is going to be different from the equity futures. So by standardizing these at the contract level, they somehow still appear to be comparable because they would still represent equally the size of the inventory frictions versus the size of the adverse selection friction. So we've been very careful to maintain this comparability between contracts.
I think probably you at least need to control for symbol and things.
Yeah, so we have symbol fixed effects. That's very easy.
Yeah.
But we also know that some market makers take much longer inventory positions, much larger swings in some contract versus another. Because, for example, a government bond is not hardly as risky as an equity future. So in equity future, we would expect smaller quantities because just inherently the asset is much more risky. So by standardizing this at the asset level, we've been very careful to scale this appropriately because it's not just a linear regression. We also have this structural interpretation of this regression, and then we want to have that both of them are going to be correctly and comparable. But I think in an appendix, or at least in an individual analysis, we also just took the simple approach of repeating the same table per contract, and then results were very similar. So I recall that in the equity futures, the adverse selection component was slightly larger, which kind of makes sense because there should be more informed trading, whereas in the bond futures, the inventory component was relatively larger than the adverse selection, but it's small differences really. So that's why we decided to just pull it in this fashion. Yeah, thank you.
Sorry, can I ask a question?
Yes, please.
I'm wondering, can the market maker change their position in the queue? Because if the codes are binding, I cannot change if I'm the market maker, I cannot change my position. I can just take it as given, or?
That's correct. You can't change it. In the end, you just have to submit your limit order at the end of the queue. But we still had to show this in the paper that you cannot jump the queue, if you will, because, the queue position is going to be fixed. So this queue position is going to generate all the frictions. So we need to show that actually, indeed, the market makers most eager to trade do not somehow empirically get an advantage in queue position. You might expect that this would be the case, but for example, they have a quicker incentive to be the first in the queue. For example, suppose we look at the ask side. Public news comes around that the true fundamental value is a little bit lower. So everyone's going to rush to a new best ask price level to submit limit orders there. Perhaps in such a case, the ones most eager to trade would be able to kind of come in first. That's a possibility. We just check the data to make sure that this is not the case. So in the end, if you want to trade, you just have to get in line, I'm afraid.
Let's see, but if I'm on the front of queue, but I have a small queue size, after this queue is hidden, if I submit a new code, I will end up in the last.
Yes, that's right. So the way it works is in this market is quite standard, I think. So if you have, let's say, a resting order of 3 contracts, you can cancel a part of it. For example, cancel 1 share and then have still 2 contracts left, and then you remain queue position. But you cannot increase your contract. If you would increase it, you would have to submit a new limit order at the end of the queue. So that's the way the queuing works.
That's very interesting. Thank you.
Thank you.
Folks, I think we are kind of getting to the end, unless there are any remaining questions. And if there are none, then I wanted to thank Vincent, Marius, and Corey for joining us today, and all of you, of course, for being here. And we'll be happy to see you again in 2 weeks.
Yeah, thank you so much.
Bye, everyone.
Bye-bye.